Hey everyone, did you know that Ashtead Technology is the number one shorted stock in the UK right now? And they've just released their H1 earnings. I'm going to go through this for what I made of it, and I'll give you my opinion on the company, and I'm going to answer some of the pushback that I got from analysts about the company and the industry. So, yeah, we'll also talk a little bit about that short interest position. So, I'm not short in this, I'm long in this. So this will be interesting to see why I'm long against the overwhelming institutional money that's going into the short side of this investment. So, all right, let's jump in.
So here's my take on the half year 2025 results from Ashtead Technology. So let's have a little look through here. Now, they've got some highlights here. Not nothing new from previous announcements. They've actually already signaled this to the market earlier. The only thing I kind of want to show is that the margin is still holding up. This is their adjusted margins, but it's 27% is stable for what they've been um, being able to pull off in the past. They've also, you can have a little read through this yourself, but the progress on some of their acquisitions from 6 months ago with Seatronics and J2 Subsea have been going quite well apparently, and yeah, they seem very positive and buoyant about how that has actually they've been able to find some hidden value in that business. So essentially, the equipment wasn't as bad as they kind of had budgeted for. They thought they were going to have to replace a bit and fix a fair bit, but there was actually a fair bit better quality than they thought. So they've been able to put that into the fleet quicker, and they're pretty happy about what they've found, I think. So I won't go through why I think this is a good business. They sort of explain it a little bit here, but I think it's more important to just jump into the numbers. I'm going to assume you already know why this is a good business. Here are some of their numbers for H1. So a little under 100 million for revenue. Now, that is down organically. So there's some organic decline of about 6%. And then the reason this has grown 19 million from is through the acquisitions. So this is um, yeah, maybe a little lower than what they were hoping for. If you've got a little bit of organic growth, they're sort of looking for high single digits, 10% kind of organic growth, that kind of range. Now, what's the explanation from management was this, that H1, there were a few things that didn't quite go their way. A few things got delayed. A few projects from their clients got delayed. A few there's been a bit of headwind in the US with some of their offshore wind stuff, even though that makes up only a few percentage points of their business. There were some foreign exchange fluctuations as well. And yeah, the delays in projects was really more the issue. But they were very adamant that a lot of that has come through that they were expecting in H1 that kind of just didn't quite fall into H1, has fallen into H2. And they explained in detail about how they've won some work where some of their gear has gone out for 200, 300 days on rentals, on big projects off Africa and things like that. So I'm they're guiding for a better second half. Um, Even if they were to double, just have the same as H1, you're talking 200 million. I think it's going to be higher than that. I think it's going to be 210, 220, something in that range, um, revenue for the year. And they're going to be trying to aim to keep this margin, um, this margin here, 27% margin. They're going to try to be keeping it like that. This return on invested capital number has came down a little bit. That's obviously going to be through on the acquisitions, and that leverage obviously because of the acquisition too. So they're going to try to get that leverage down to 1.4x by the end of the year naturally, which means just the cash flow that's coming through paying down some of their debt. That's going to be one of their priorities to get this down a little bit. 1.6 I actually don't think is that significant anyway. It's high enough. Once you go over 2, you started and go, oh, that's starting to be a bit high on the debt side. But 1.6 I think is very manageable. That's going to get paid down pretty quickly. I'm actually not too concerned there. Now, if they've got 21.9p for their earnings per share for the half, right? I'm confident that they're going to get at least that again in H2. So we're talking in the 40p range, 45p, something like that. I do think H2 is going to be better than H1. So we're talking 45p for a market cap company that is, this is about a 7 to 8x earnings per share company at the moment. So yeah, I think that's of pretty interesting value. All right, go through your profit and loss and the balance sheet in your own time. You can go through how the debt bridge has been working. Again, you can go through that in your own time. This is what they want to focus their capital allocation on. There was a few questions that came up about share buybacks, and they're really kind of leaning towards getting that debt down first. So they would prefer to get the debt down, then invest here in their organic fleet growth, okay, and their bolt-on acquisitions. That's where they want to spend their money. There's a little tiny dividend here, which I am going to ask them about one day, about why bother with the tiny dividend, where they got the return on invested capital well above 20%. Just use that money to go buy some more gear and rent it out. So that would be my question there, but it's tiny. We're talking not even $1 million worth. So yeah, it's a fraction of a percent. So share buybacks are not on the cards, and I'm okay with that considering the opportunity they've got here. Scale is what they're trying to chase. And as you might understand from this company already, the scale advantage you get by being the biggest gives you some advantages. And this is what management, both CEO and CFO, had been talking about in this call as well, which was that's where they see this going, which is you've got a bigger fleet. You'll be able to be a one-stop shop for your big clients, which means you can imagine how beneficial that'll be. I'll actually explain a little bit more about that later, but that's what they're gunning for. Let's have a look at the industry that they're operating in. Here's a little bit of how it's been unfolding over the past and what they're hoping it unfolds like into the next few years as well. We're at 2025, so just here in 2/3 of the way across this graph, okay? And they're thinking that decommission is going to grow about at 14%, offshore wind at about 15%, oil and gas construction at around 4%, okay? Which gives them about an 8% per annum compound annual growth rate. This is industry wide, not specific to this business. It's just they're talking about the industry as a whole here. Okay, a little bit more on the oil and gas spend, how it's forecasted to increase. You can have a little look at that yourself. I'm not going to go into too much detail there, just because I think it's speculating a little bit on what may or may not happen. Hard to know. Oil price interferes with this quite significantly, so I'm not going to waste too much time on that one. The offshore wind market, headwinds is an interesting word they use. So yeah, there's been some issues with the US, so going sort of against the idea of offshore wind and green energy support, sort of moving back towards oil, coal, things like that, which offshore oil is still going to be a big beneficiary of Ashtead Technology anyway, since 75% of the business is oil and gas, offshore oil and gas projects. So the fact that wind is in decline a little bit, potentially, that's sort of the ups and downs of the industry that they're in. And what I think is a good indicator of where this is going is the backlog. And this is what this page here is. So you can sort of see that what they're trying to show here is their client Subsea 7, Saipem, which is they're actually merging some of their two big clients are actually going to be merging together, these two down here. And this is their backlog that these public companies, and I've been able to confirm this by looking at the public release documents for these companies here, Subsea 7, Saipem, and Technum, FMC. Their backlogs are looking good. Their backlogs are improving and getting pushed out further and further. There are often delays in these things, though. Political instability delays, timing of funding, all sorts of little things that kind of can push these backlogs out. But the idea is the backlog is getting bigger, right? The number is growing. So the work is getting more, even if it's going to get delayed by a little bit here on a short-term scale. Yeah, okay, maybe it happened a little bit in H1. Some of it didn't quite come through, but it pulls through in H2, and it kind of then get pushed into the next H1, and the outlook is in this sort of this direction in a positive way. So that's, I think, pretty important to understand as well. They go through here their Seatronics and J2 subsea. They went through quite a bit of information about how that's going and why that's going well. They're really happy about it and what they paid for it. So 5.2x the EBITDA multiple is what they paid. They paid 63 million for it in total. Yeah, and it's been integrating actually really well. They're really proud, really happy with how that's working out. They went through some information here about how they're supporting a West African project and how it's a 200-day commitment. And yeah, they've got quite a lot of their product range. So like not just one specific area, they've got all of their areas sort of their fleet is getting used for in this project. So that's sort of what they're gunning towards in the future. Okay, then they talked about their outlook, and then there was questions, blah, blah, blah. Now I'm going to sort of go through some negative comments, not comments made here in the Q&A, but what I have picked up from other analysts and things like that about Ashtead Technology. So they're a little concerned about earnings momentum has turned more negative recently. Now my answer to earnings momentum is this. Well, in the most recent half, yeah, organic growth is slightly down. But like I said earlier in this video, is that H2 is looking good. Orders have been booked. There's quite a bit of work scheduled that was supposed to be in H1 is pushed into H2, which now has been confirmed to have been picked up. Now that was what I got from the Q&A session, was that H2 did pick up the work that was from H1. It didn't just get cancelled; it just got pushed. So that's good. So I think it's very likely that they're going to do over 200 million revenue for the year. I'm going to pencil it in at about 210 million. We'll see what actually comes through. And 210 million is going to put that earnings per share well into the mid 40p range. Okay. The pricing environment, when things get post-COVID, it was a little bit tight. So they had pricing power. If pricing power doesn't hold, it can be savage to the profit and loss statement. Okay, so that was the question. That was sort of the comment from analysts. Now I agree that there is some risk there with this. There is an element of pricing competition getting tough when there isn't as much work around. Okay, but that's not quite fair for Ashtead Technology at the moment because they have a global reach. So as things stall in the US, for the wind in the US, for example, South America and Africa then has picked up. So as offshore wind slows, offshore oil can pick up. That doesn't always happen. You can get a decline in both at the same time. And that is a risk that we are going to be taking by investing in this company. But I do think they have these scale advantages. So now that they're getting bigger, and they're one of the biggest players in the market, I think they are the biggest player. They're now more of a one-stop shop for the clients, and I think that's the underrated part of this idea. This is not just a commodity, like just a lot of other rental companies you can think of. They're like, oh, a tractor is a tractor, right? I can get one from this company or that company. Let's just go for the cheapest price. That's not quite the same with this industry. The reason is because if you've got a job on an offshore oil platform, there's always going to be maintenance and decommissioning to do, not just the new projects. Then if you're a project management team at one of these big companies and you're coordinating this big job, right? It's going to be a big deal for them to get reliable gear and all of the gear together. And if they're renting equipment from 5 different places, that's going to be 5 times the coordination effort needed. And then they got to get those deliveries timed to together arriving at a similar time. You've got to do all the extra paperwork, all the extra back and forth with the 5 different suppliers of the gear. It would be far better if they just had a one-stop shop where they get everything they needed. So their price sensitivity on this is going to be far less on the big projects, because the cost of renting the gear from Ashtead Technology for all of the equipment that they need might be, say, I don't know, $5,000 a day. Whereas the barge itself and the crew that are going out on that barge for the time frame that they need to, maybe 200 days, 300 days, 400 days, that's probably at like what, $120,000 a day they're going to have to charge for that crew and the barge. So the $5,000 of gear, but whether it's 5,300, 5,500, it's really more about the convenience of getting it all together and having the expertise that comes along with it, the guarantee that it's actually going to work, it's going to arrive on time, it's going to be maintained. They can send somebody out to troubleshoot if they need to. Losing a few days or a few weeks because of equipment delays from one particular supplier that has just supplying just one little thing, that could be really costly. So it's not worth the hassle of working with multiple different people to save a few bucks. It's better to get it all organized in one reliable person. So although pricing is a risk, you would actually think it would come up in that margin compression. So because the margins, I'll show you back on the screen here. Where are the margins? Here they are here. So you got H1 22 at 26%, 23 over at 30%, 28%, 27%. That's solid. They've been holding, they've been strong. That's strong margins, and they've been stable margins. So you would think if there were serious pricing issues in the industry with lots of different competitors like gutting their prices just trying to win work, you would see this come through in their margin. And then if they were actually technology were adamant that they had to hold their margin, then you'd see it come through in the revenue, or you'd see it decline in their what they call the utilization rate. So how much gear is actually out, on rental, and their utilization rate is somewhere in the 40% range. I think it's about 45% at the moment, and that has been stable too. So over the years, you would going to see, if you can look at the utilization rate, whether that's in decline, that's going to be an issue. If you see margins in decline, that's going to be an issue. And if you see essentially those two things, if those two things are not stable, well, then you can, I think you can say that there's pricing issues in the industry. But that is not what's happening at the moment. So, and I think the scale that they're getting is meaning that that's not going to happen in the future. I think it's very unlikely anyway. Doesn't mean it still might happen, but I just don't think it will. And I think that's where the analysts are missing the the nuance there. Anyway, okay. Offshore wind industry one of the analysts thinks that the offshore wind industry is imploding a little. And although there might be some backlog, it's going to get worse. But that's not what the numbers look like. We saw the backlog earlier. The backlog is increasing. Plus, offshore wind is only about 25% of Ashtead Technology's business. And it's soft in the US right now, and that's about 2% of Ashtead Technology's business. Whereas wind is still going okay in other parts of the world. And oil has been picking up in South America and Africa. And considering their equipment, 85% of it can be rented on either wind or oil projects. That softens the cyclicality of the swings of the sector as well. So I think that sort of answers that question. But there is still some cyclicality that does exist, and I think it could be a bit soft coming up. But like those backlogs suggest, they're higher than ever. And the big thesis here is that energy is needed in the world. I'm quite bullish on energy, and bullish on countries trying to be more energy secure. So there is a place for offshore wind and oil to continue, because that's what certain countries have. If that's the reserves they've got access to, they're going to be wanting to be energy secure, and energy is going to be important. I think this continues. Now, one thing that was raised by an analyst is that now Ashtead Technologies is the number one shorted stock in the UK. It's at about a 7% short interest at the moment. I'll try to find a screenshot of that at some point here and just show it on the screen. But 7%, I think, doesn't actually seem that high, but it does give you some caution as to why someone in some of these companies would be shorting Ashtead Technology. They obviously have some reasons for that. They're not just shorting it for fun. So they're shorting it because they disagree with some of the thesis that I've probably just outlined. That is very interesting to me, why there's such short interest, and it's probably why there's been such a big pricing pressure on the stock, is not only the short interest from it, but some of the issues that they think about pricing and all those things that I just talked about. I think that's why the price has come back about 60%. So yeah, I think if Ashley Technology had no competitive advantage over other equipment rental companies, um, yeah, that would be a concern. But I think they do have some edge. I think their equipment range, the global reach that they have, the expertise and the track record that they have, is their competitive advantage, and that's growing as they scale and as they make more acquisitions. Now, this is far from a bulletproof moat, but I also don't think they're just an average, regular equipment rental company. They're better than that. So yeah, like I said earlier about the utilization rate, that's going to be a good number to track in the rental business, and the margin of the business, the EBITDA margin as well. I think, yeah, that's going to be important. You don't want that, the utilization rate, by the way, you don't want that at 100%. 100% would be bad, because clients then can't get what they want because everything is busy. They don't have enough gear to be helpful. So because when a client needs the gear, they need the gear. So you got to have it ready to go for them, so they think you're reliable. But if you don't, if you got too much gear and not renting out enough, and you're just keeping some just in case all the time, like say you got a 20% utilization rate, well, that would be bad as a return on your assets. So you've got to balance it somewhere between getting a good return on your assets, but always having gear available when clients are desperate. So somewhere between the 40 and 60% range, I've learned, is pretty good. And Ashtead Technology are really stable at about 45%. And combine that with tracking the margins is the way I'm going to track this going forward. And yeah, maybe some bad times are coming in global offshore energy. That's a bit of an unknown. I would probably need to go to a conference or two to get a feel for the market. But based on the public company clients of Ashtead Technology, who are winning, and Ashtead Technology winning big projects around the world, that backlog never being higher, yeah, I guess they could get cancelled, some of those projects. But like I said, the thesis that energy is needed, countries going to want to have energy security, and offshore plays a big role in the energy requirements of the world. I don't see that happening. So yeah, like I said, maybe I could be wrong. All right, hope you've enjoyed all of that analysis and the Q&A there. Let me know what you think of Ashtead Technologies, and whether you think the short interest is justified or not. That would be an interesting conversation to have. Otherwise, yeah, see you. We'll do this again in 6 months for the next update for Ashtead Technology, and I'll talk to you more then.